Hey everyone, welcome to episode 14 of the J&J Show.
Yep.
We have a special guest today who I'll introduce in a minute, but I'm Joe.
I'm Josh.
Perfect. Today I'd like to introduce Sonali Basak. Did I pronounce that correctly?
Basak, so
I know, you told me like 3 times and I messed it up.
Not an easy name.
No, but next time I'll get it right.
Yeah, I'm very good at simplifying complex themes outside of my own name.
Right, perfect. If you do a good job,
It's foreshadowing, I can tell.
if you do a good job, we'll have you back and I'll get it right next time,
Yeah,
all right?
deal,
Or maybe
deal.
I'll mess it up again. I don't know. Right? So Sonali is the Chief Investment Strategist at iCapital. Would you like to share a little bit about what you do there?
Yeah, a chief investment strategist at iCapital. We have a public side of the business that is largely structured investments, and a private side. It's about 280 billion and 315 billion or so on the platform. We work with 1,250 general partners, so asset management firms today, and a total of 180,000 financial professionals. And so the idea here is how to think about asset allocation. How do we take the macro and feed through across asset classes to keep our clients on top of the upcoming opportunity in the market?
Yeah. Welcome.
And iCapital isn't necessarily a name a lot of people would see on their statements, or it's more of operating in the background. Am I correct in that?
Exactly.
It's designing, it's structuring, it's background products that might have someone else's branding on them, for example.
Yes, the wealth management firms know us, the asset management firms know us, but the end investor are working through those counterparties, and we're supporting the ecosystem.
Perfect. Well, thinking about asset allocation, right? Obviously, a lot going on in the world today. And why don't you give us a kind of a big picture view of kind of how you see the world and what you guys are thinking as far as asset allocation for your typical client.
Yeah, first half of the year versus second half of the
Yeah.
year. Will it be
Yeah.
the same? Often isn't. Now we're in summer, so
So let's take a big step back, right? We came into this year, growth was quite strong, barring a few hiccups like the government shutdown at the end of last year. You had that give back at the beginning of the year. You had the tax refunds. We had a lot of tailwinds.
Yeah.
We are looking at the second half and saying, okay, which of those tailwinds go away? Tax refunds is the obvious one. The less obvious one to me is perhaps the Federal Reserve support of the market, the bill buying program that existed that really fueled liquidity to a meaningful degree. Now, even without that kind of a tailwind, you still have ample liquidity in the market, tons of money in money market funds. There is dry powder on the sidelines. We're not saying that liquidity dries up. We're just saying that maybe it's not as ample as it was in the first half of the year. And then finally, it's the AI CapEx story.
Yep.
There have been changing winds to the story coming into this year. October of last year was really the flashpoint where you started to see a little bit of a buyer's strike. Investors starting to say, well, okay, we are going to be paying more attention to companies that are spending and what ROI they get back in. Now, if you fast forward to this part of the year, that CapEx is coming at a cost. You're seeing a really ferocious amount of capital markets activity coming to the surface, and we think that will continue. We just think that it will have ramifications for how investors engage with the trade.
Yeah. Nice. Well, as far as, with all that going on, what would be the biggest change you would make to a standard allocation right now? Like where should we be looking at, for our clients?
You look at the street estimates and there are still fairly bullish set of considerations for what the year would look like. We're kind of middling in our base case assumptions. We don't make price targets. We just look at fair value. Our range that we're publishing is between 6,800 and 7,800. And it's because we still see downside risk to the market this year. We do think that there could be buying opportunities in that. We do think that this is the time to think about downside protection. We think also on correlated returns. Where are you getting uncorrelated returns in a market that's fueled so heavily by artificial intelligence?
Yeah, so it's a conversation we have all the time. Like, where do we go for that? Yeah.
Yeah, and so in the private markets, we're seeing more people starting to ask about hedge funds to add that uncorrelated exposure. We're seeing a lot of people ask about infrastructure outside of the data center trade. And that is really exciting because infrastructure does perform well in moderate to high inflation environments. That is the environment that we're in today and for the foreseeable future. So there are places to go, albeit probably not that many, though there are probably parts of the market that have been punished undeservingly so.
Yeah.
I use financials as an example. If you really think that AI is going to be a $5 trillion build out for the next 4-5 years, then wouldn't the banks behind those build outs that are
be some
clipping
lending going on.
fees?
Yep.
There's lending, there's capital markets fees. And so we've seen every quarter a lot of optimism form around what can be done in capital markets, but the trade hasn't actually played out. And so we think that that's probably a lost opportunity in today's market.
Yeah. A lot of our clients, speaking of AI, space, SpaceX just came out. A lot of our clients were asking us ahead of time,
Yep.
are we going to get it on SpaceX? What are we going to do there? We did not.
No,
we
we did
felt
not.
that kind of what happened was going to happen is, you're going to get all that,
Standard IPO behavior.
yeah,
Right.
yep. So and it kind of
So,
shot up, came back
Yeah.
down. What do you think? And again, because our clients, they're going to ask us about
Yeah.
this. What do you think about SpaceX long term? Is it something that we should be looking at in the short term, or is it something that's 5 years down the road or 10 years down the
I
road?
guess one of my questions as a subset of that is, are we viewing it as an actual theme? Is it just a few companies? Is it Virgin Galactic, ASTS? Is it just a few companies that are creating a theme or a sector, or
I
is
think
it
if
larger
you
than that?
think about SpaceX, what's the first thing that comes to mind?
A specific
ships.
person?
Rocket ships, yeah.
Oh, okay.
To me, it's Starlink. I think Starlink is critical infrastructure around the world. It's hard to see it any
Yep.
other way right now. And that moat that it has would only keep growing. It is critical, and it is infrastructure. There's also a capital structure story here. Do they merge with Tesla? What does that mean for investors? I do think that the choppiness that has been experienced in the stock in the early days of the IPO, or post-IPO rather, doesn't spell the story yet, because we do have those lockups expiring. One advantage we have from where I sit is we have a lot of pre-IPO investors in SpaceX on the platform. And so we have talked to a lot of those earlier investors, and they will repeatedly say that some of them have to sell. Why is that? The venture capital community has this DPI issue. What does that mean? Their distributions are simply not what investors have wanted. And so even if they wanted to hold, they might sell some, and we just don't know what it's going to look like yet across the board. There could be more buyers, but if you really think that there's going to be volatility and you want to get into SpaceX, it's a nice reminder that you don't need to buy at the top or the perceived top right now.
Certainly. Other areas, so talking about space, talking about AI, so a little bit of a rotation now. Okay, NVIDIA was a darling for quite a while. Now Micron is a heck of a place to talk about. Do we think the volatility in individual company names in the AI trade or AI space will continue? Do we think there will be some level of equilibrium? Or, to use the word you're using, which I think is correct, is it the infrastructure around AI?
It has to change. And this is why. So when you came into this year, the race between Anthropic and OpenAI got very intense, to the point that Anthropic enterprise adoption surpassed that of OpenAI. And they ran in many different ecosystems, didn't they? So that was one big part of the story. These large LLM companies, in and of themselves, they're so large, generating tremendous run rates of revenue, but then where are they spending money? And that ecosystem is growing. So you take NVIDIA and the competition that you would get from Google and Amazon and how that might build over time. We just don't have all the answers for that yet. So it's hard to make a real call. Now, with that said, I think as a broader story here, it's really healthy. These are American capital markets. You don't want one king in the room. You want a healthy group of companies that are rising alongside a megatrend, which is what's happening now. The problem with the AI megatrend, and what we spend a lot of time on, is not just the ROI, but bringing it even down to the unit economics. So token spend. This has been one of the hottest topics this year, how much a company spends on tokens. And if you look at ramp data, the difference between the top 10% of spenders on a corporate level per employee, it's like $600. But then the median, I believe, is closer to $11. So there's a massive degree of spend that you're seeing in terms of dispersion of companies that are willing to put dollars to work today in AI. And so until you see that broader enterprise adoption at scale, then what becomes of token costs? Because those really big spenders are saying, well, wait a minute, I'm spending way too much, and it's not because I'm getting this great return on it. I'm just seeing my employees burn too many tokens inefficiently. So how do I get a handle on that?
Awesome. Bringing it back out, allocation-wise, last year we kind of added to our international allocation, done well, not doing as well right now. Small caps seem to be picking up. What are you thinking?
So you mean you don't want to talk about token costs all day? Okay, got it.
Just the majority, but
Yeah.
depends on the audience.
So
We probably have some clients like, what are where are we putting these tokens and what are we doing with
NFTs.
them? Yep, exactly.
in international, I think I'm glad you asked, because to me, one of the most complex stories is Korea. On one hand, I was on my way over to taping with you guys. I was reading a Goldman report on how much Korea will be a beneficiary of humanoid robot build-outs. So
Very
interesting.
specific.
It is very specific. And, you have to think about it from all these angles, because if you look at the Korean stock market with 2 companies accounting for so much of the share of the index, you worry about that with the run-up that we've had. You worry about it even more when you think about how many levered ETFs have been tied to those names, particularly SK Hynix. And then SK Hynix is thinking about a listing in the United States. So then how does that change the market structure? So in my mind, when we're thinking about international, the question is, what are you really investing in? And how do you gain exposure? We think Japan is a very interesting story. We think that there's a lot of room to run there, given all of the changes you're seeing in corporate America, a lot of companies that were previously conglomerates looking to spin off assets, a really robust private equity community forming around that, an activist community. There's one year where there were more activist campaigns in Japan than there were in the United States because of, and that has been more of a trend. You're just seeing more investors looking to seek change. So very, very exciting. Europe, I worry about a little bit, just kind of their closeness to a lot of the energy and supply chain issues we've been seeing.
In a previous podcast, one of our guests was talking a little about Germany and kind of liked what was going on in
fiscal
Germany.
spend.
Yeah. What are your thoughts there?
I
And you can feel free to disagree, right? You don't have to agree
And
with.
times change.
Yeah.
I mean, wouldn't you invest in America for the same reason?
Yeah.
I don't think that there is any spot in the world right now that is not thinking about defense as a core issue. And if you're asking about what it is you're investing in, am I investing in a place like Germany because I believe in the fiscal spend behind the defense trend? Or am I investing in the defense theme, and is there a better way to go about that? I think that is the ultimate issue, which also, by the way, goes back to your SpaceX story.
Yes. Well, speaking about defense theme, U.S., what are your thoughts there?
Defense spend has to grow. I think one thing that's probably undercovered is the relationship between defense and technology. Let's just take what we saw this year as an example. A lot of people really talking through what was it ultimately that made it so difficult to pass through the Strait of Hormuz. The fact that a $10,000 drone could be what stops you from getting through.
One-way drone. Yeah.
Exactly. And so the cost of warfare has just plummeted, hasn't it? And so the question is, how do you think about the technologies that are going to be kind of the true defense system of the future? Because it's not as physical as perhaps it used to be. And there are a lot of minds and a lot of new dollars that are going to that trend, and it's not stopping.
Nice. And then we talked a little about small companies. And I wasn't even aware until Josh pointed out to me a couple of days ago the returns on small
well,
caps.
Russell's done
so far. So, we hadn't been watching or.
You mean like the index performance?
Yeah.
Right. Not the fact that 40% of the index.
No, because we take that as a constant. We take that as a constant in that environment.
It bothers me, right? This is kind of what I meant about our ability to go from public to private so much. 86% of all companies with revenue over $100 million are private. Companies have gone public less often, later in life. And so I want to like the small caps. From a valuation perspective, there are certainly interesting opportunities. More interesting, right? If you look at the S&P mid or, right, you really have a lot of very interesting valuation plays. And so I think for me, my preferred way of playing it is the broadening rather than size alone.
Yeah, we were talking at lunch with another firm that was actually professing their love for mid caps. So. And
but it's been painful.
Yeah,
we may have less mid cap than we started with.
We do. And that was our comment. Well, we have a lot less mid cap than we did in January today.
But the problem is, right, this has been a trader's market, right? People who have not gone with the flows have been punished for it. I love mid caps, but that doesn't mean it's going to be a good trade. You know, I love them on the old school ways of thinking about markets. I like it on valuations. I like it on the fact that we have synchronized economic growth, that manufacturing has been looking good in the U.S., consumer has been resilient. All the macro reasons you're supposed to love it, but it just doesn't mean it's going to perform.
Yeah.
No.
Yeah. We got some big events coming this year. We have some midterm elections, right? That should kind of have some effects. What are your thoughts around the midterms and, what we might expect with the markets, and their reaction based on the way we think that they're going to go?
A lot of people want to talk straight to equities without really thinking through what I think is the biggest risk to equities. And I think this is more and more so as time goes on. It's the fiscal as it pertains to the bond market.
Yep.
If we think about the 10-year, we just very simply try to break it down into the three components that matter most, which is absolute level of interest rates, right? If are rates going up or down on the short end, and how will that impact the long end? Inflation and inflation expectations, and finally, term premium.
Yep.
And so while there might not be a whole lot of room for Congress to act meaningfully to close the K-shaped economy, the reality is if we look at what happened with the oil price shock, it's a regressive tax. Inflation is a regressive tax. You have oil prices being a lot larger share of wallet in terms of energy spend for a lower income household than a higher income one. It's why the aggregate data is held up.
Absolutely.
All of that. So what is the government going to do to help ease fiscal situations across the United States in an era where we do still have elevated inflation? We do think that inflation could start to peak now that we have oil prices also having generally peaked, so long as things stay generally peaceful. But we don't know for sure how long it'll stay this high. And so, this is all to say that the bond market, if it's sticky, there's a fourth element. We were talking about the three. Actually, the U.S. government bond market has been very vulnerable to international shocks. So you think the Liz Truss moment and how that spilled over into the U.S. bond market. Even hiccups in Japanese bonds have also spilled over. And so those kinds of hiccups could start to push towards the upper bound. We were putting our upper bound at 4.8% on the 10-year. And so that's where I worry a little bit about risk appetite when you couple it with what we were talking about before with liquidity starting to be a little more constrained than it was at the beginning part of 2026.
Awesome.
Well, and on midterms, we have two sides of the camp we often talk to is, depending on how midterms go, nothing will get done, period. Nothing. Well, what does that exactly mean? Or things will go favorably for one camp more than the other, and things will be pushed through in the remaining time we have. Without putting money on the table, how do you think about it? How do you feel about it? Do you have an expected outcome?
Midterm years tend to be middling for the S&P 500, right? I mean, what? It's between 4 and 6% of a return.
Rather muted.
Yeah, but tends to do better after once there's a little bit more clarity. And that's, news you can use, right? How do you think about what the real impact of the midterm is? It's why I keep looking at what the potential fiscal spend is. Because outside of that, I don't think it makes a difference to markets.
Because we were talking with another economist a few months back, and the expectation was, everything's going to go blue in the midterms. So, does that have
the pendulum would swing?
Does that have a radical effect on anything fiscally for us in your mind, or is it just as a non-factor?
I think that the things that if you look at blue versus red, there's some areas like housing. It's everybody's problem, right? And those are the things that impact the real economy at the end of the day. So I do think the K-shape that we're seeing in the economy is bad enough that both sides have to deal with it.
Perfect. Well, my question for you is, what has surprised you most this year as far as, the economy or just, global or even locally or...
The market's resilience. We had a pretty extreme amount of geopolitical conflict in the first half of the year. Now, if you looked at oil prices, right, you did not have them go as high or for as long as we saw in 2022. And so it had that going for it. But if you saw the scale of what was being impacted, you would have thought there would have been more of an impact. And you would have thought that investors would have been more skittish to it because, let's just take LNG. we're not just talking about oil here.
Yeah.
We're talking about various commodities that have very meaningful impacts to supply chains. Aluminum was something we were obsessed with. Tungsten prices, we were obsessed with it. Because you did see meaningful elevation, but it does make it hard for an investor, doesn't it? I'm sure you guys are feeling the same, where a lot of our investors are asking about how do we think about commodity prices in this era?
That was going to be a subset based on what you're saying.
Yeah.
Yes, because
So tough.
we often don't. It's not really a space we go too far into.
Well, it's really even harder to do so now after these run-ups.
Yep.
At least not with downside protection. I love gold. Personally, I think gold is a very interesting asset and ever more important as we think about the central banks and how they're changing their allocations and the future of the dollar and the lack of correlation to other asset classes. However, this year was a very tough entry point for gold.
Very much so.
The most classic of commodities. And so how gold behaved, I would say, is another big surprise, just kind of the big drawdown we saw. But I do think the gold momentum rally you saw at the beginning of the year also kind of speaks to what we were saying. If you're not on the side of momentum, you can get caught pretty flat-footed. And so you have to respect the momentum, I think, in this market.
Awesome. What else you got, Josh?
And there's any number of things to talk about. Well, one that always comes to mind, and maybe it's just my own demographic or age group, is how much of the market is being driven by traditional, to your point, earnings, revenues, and how much is the number of times it was tweeted or the number of people that spoke about it on Reddit. And there seems to be a growing separation between those. We go back a few years, GameStop was a prime example. Nothing motivating, a few 100% of growth.
Well, let me ask you this. Let me throw it back. How many of your clients are asking for single stock exposure versus index exposure?
Now versus 6 months ago? Is it increased?
Well, it increased when SpaceX came out. I got a lot of calls on that one, but
Not during the software sell-off?
Yeah,
That would have been a good time.
Yes,
Yeah.
that's true.
but probably more than previously. But again, you see it with social media.
It happened with NVIDIA.
Yeah.
So that was the first time we don't do a lot of individual securities exposure, individual stocks. But then when you read in the headlines 5, 6, 12 times in mainstream headlines, we then start getting some questions about it.
I'm going to say something very unpopular to the retail crowd. It's kind of like, well, okay, are we chasing a trade or are we chasing an investment?
Yeah,
Because
fair.
chasing a meme stock rally, it's a trade.
Yep.
Yep.
There's room for that.
Yeah.
It's just not an investment.
Listen, I got 9 great ideas for investments on Instagram last night.
That's true.
Not going to do any of them, but
That's right.
Right,
but
good to
it's
know.
crazy how you see that out there now.
A friend of mine runs the equities research at Citadel Securities. Citadel Securities has been seeing elevated retail interest, of course, in the markets that actually intensified after tax season in a very interesting way, which is, when I said everything I said about liquidity, wonder what that looks like in that second half of the year. And so it's interesting, clearly, since COVID especially, retail investors are a bigger and bigger part of the market.
Absolutely.
I think also, given all we're seeing in terms of how levered a lot of other big fund managers are, it's an active management market. I don't think that is a deniable thing. And I do think that the single stock phenomenon is beyond the retail investor. And here's why. So think about software. Software, not everything's going to win. Just like what we were talking about in AI, not everything's going to win. And so it's going to force investors to really think through, well, okay, what are the companies of tomorrow?
Yeah.
Because simply, there's this interesting thing. Vista Equity Partners, big private asset manager, they're calling it the rule of 70 now. Used to be the rule of 40.
Yeah.
So if you take the rule of 70 and demand that public companies need to have a revenue and profit growth rate that equal up to 70 instead of 40, that is
Meaningful.
Yep.
Yeah, and so that is the future that I'm operating under. That investors are going to demand a lot more for their dollars, and I think it's a future everyone kind of has to prepare for now.
And you're right, not everybody's going to win. It's funny, I talk about that with clients all the time when they ask me about AI or, when they ask me, what cryptocurrency should I buy? I always harken back to, I look at them as kind of where the internet was in, 1990, right? And I ask them, if you were going to buy an internet stock in 1990, who would it have been? It would have been Google. It'd have been AOL. It'd have been Earthlink, right? And where are those companies now? So we may not even know who the winners in those space are at this point.
The private markets giants that have been kind of like wading through this period of uncertainty with AI and software and private credit and all that jazz, they're tightening duration.
Yeah.
So instead of underwriting something to 10 years, then they went to 5 years, now it's gone to 3 years. And what that really says at the end of the day is we can't look past 3 years
Yeah.
Yeah.
when we're putting money in the ground.
No. And honestly, in some of these spaces, the ultimate winners may not even exist right now.
Yeah,
And that's, that's
absolutely.
the thing people don't really think about.
I think about that in terms of new business formation. People say, well, all these companies are being formed because it's so easy to code right now because of vibe coding. But how many of those companies are going to be eaten away if OpenAI and Anthropic just say, well, okay, I have a new tool for lawyers. I have a new tool for doctors. I have a new tool for accountants. And so it's tough because there's a lot of new business forming that might be susceptible to a larger company just coming in and saying, I'm going to do it myself.
Yep.
And everybody seems to get caught up in the hype. That's what we're seeing, right?
Yeah.
And again, that's where that social media and all this stuff comes into play. You're seeing this and that everywhere. And it's like, well, it's got to be the best thing in the world because I saw it on Instagram and I saw it on TikTok and I saw it everywhere. So it's,
But it's kind of, you have to be kind of a voracious consumer of all the new information, right? I mean, I'm driving my husband crazy with the podcast that we listen to on a Sunday morning because I want to know what's happening in the supply chain. I want to know what's happening in token costs. I want to know how that's impacting the wealth management industry and the financial industry and the healthcare industry, because how are we going to otherwise have a really good sense of where to put new dollars to work if we just don't keep a constant eye on the trends because they're changing so quickly?
Now that you said token twice, I'm going to get a call from a client say, are we going to get some of them tokens in our portfolio?
Yeah, do we
What's
have
going on with those? Where are those tokens? Do we have any of those?
tokens cheap right now? What do we think they're going to appreciate?
Should we wait on the tokens or not?
Yes.
Don't buy tokens.
There you have it.
Yeah. So we've covered a lot of different things. So I think unless you've got something else, I kind of want to end it with, what message would you give to our clients and investors out there today based on what you're seeing?
It's a great, it's funny. I was looking at somebody's philosophy on how to learn about AI. And the good way to think about it, it's not like you're just turning on a light switch. It's a progression. And so not to feel afraid of it, to give it a try, because it's kind of like, back in the day you would tell, your son or daughter, if you're going to invest in something you like. If you like Nikes, maybe that's the stock. If you like Coca-Cola, then that's the AI is a little like that, where if you can understand how to use it a little better, you can understand the trends behind it. So I do think it is a helpful exercise just to give it a try, because a lot of people are still very afraid.
Awesome. Thank you so much, Sonali. Thanks for taking the time to join us today.
Thanks for having me.
That's a wrap. I'm Joe.
I'm Josh.
Like,
Comment.
subscribe. We'll catch you next time on episode 15.